What's going on, investors? Have another big update for you guys. Big dividend news was announced this past week with 3 of the best income ETFs out there. Let's start off with FEPI, the Rex Fang and Innovation Equity Premium Income ETF. So FEPI, they are owning big tech and then they are writing covered calls on it. Super easy to understand strategy. And this gives us the chance of those juicy dividends every single month. Now, I heard some people don't like it when I say juicy. Oh man, that only motivates me to say juicy even more because these dividends, they really are juicy. And I'm getting monthly cash flow with these ETFs. So FEPI paying out those big dividends. It's writing those covered calls. They're going to be staggered, so they're not necessarily going to be just right at the money. You get some chance at capital appreciation, some upside with FEPI. Let's go over the companies that FEPI is holding on to because they have 15 great companies in this portfolio. This includes NVIDIA, AMD, Netflix. My top stock this year, Palo Alto Networks. I think they're going to do amazing. They also hold on to other companies like Microsoft, Adobe, Micron, Alphabet, Broadcom, Salesforce, and a couple others. So companies like Google and Salesforce, they actually just announced dividends this year. So this is another way that their investors are going to get rewarded with those juicy dividends. Again, doing the strategy that FEPI is doing, this is a fantastic way at growing wealth. Selling call options generates income in the form of premiums, and this can provide a steady stream of income, which can be particularly attractive if the underlying equity is stable or rising slowly. Now, this strategy, it works very well if you believe in the stock, but you have to believe that it will not rise significantly above the strike price of the call option sold. Otherwise, it's better to just buy shares of the stock rather than doing one of these income ETF option plays. Now, another benefit of this is the limited downside and the risk hedging. The income from premiums can offset minor declines in the stock price and provides a cushion against losses. Now, let's go over the dividends that FEPI just announced. So this was actually their 7th dividend payment in their short history, and it was for $1.16. So that's very nice to see, right? It went from $1.19 in March to $1.09 in April, which was actually the lowest dividend it had ever paid. And now it's already bounced back and paid us a higher dividend this year of $1.16 that's getting paid May 28th. Now, just remember, FEPI is a newer fund. Since the time period that this fund has went out, since October of 2023, the S&P 500 has done very well. So it's not still time and tested to see how this ETF will perform under a bear market, but so far it's performed very well in a bull market. So the S&P 500 in that same time span is up 22%. FEPI is up 7%. Now, this is not including dividends. And that's no surprise that FEPI isn't up as much in capital appreciation because they're giving away some of that upside in return for those juicy premiums. Now, if we factor in those dividends and we reinvest those dividends, it's actually much closer with the S&P 500's total return, which bumps FEPI all the way up to 20%. So still not beating the overall market, but as we're going to talk about, that's not exactly what these funds are designed to do. They're more so for those in the wealth preservation mode of life, not necessarily the wealth accumulation phase of life that a lot of us younger investors are in, where it might just make sense to buy the underlying equity and not have upside capped. They're also used as a hedge of volatility. So sometimes when you're already rich, you don't want your money fluctuating heavily from month to month. That's why products like FEPI can really help. So far, they're on pace to pay out a 25% annualized yield. I'm really hoping they can keep that up in bad times as well. And most importantly for me, I don't want my income ETFs experiencing NAV erosion. And as we can see, there's no NAV erosion here so far. All right, let's switch it up and talk about NEO's SPYI or SPYI. This is the S&P 500 High Income ETF. And they've actually been around for almost 2 years now. And they've paid consistent dividends that are always around that 48-cent mark. And their share price is also always around that $48 to $50 share price. Now, they just paid another dividend, another one, and this dividend was close to 50 cents a share. Very consistent with their other dividends in recent months. I love knowing that we're going to get that consistent income every single month that we can use to pay for our bills. SPYI is giving basically a 1% return every single month. Of course, it's never guaranteed. And just because they've been doing a great job of doing this for almost the past 2 years now, that doesn't necessarily mean they will do so in the future. Just keep that in mind. But one thing that I love about SPYI is that there also does not seem to be any NAV erosion going on. They have a great track record, and getting a 1% return potentially every month, that is a fantastic way to grow wealth and become very wealthy. By owning SPYI, one is owning 500 plus different companies, and then investors are also getting S&P 500 index call options done to generate those juicy dividends. It's a way to own the S&P 500 and benefit off options trading. Again, it shouldn't be confused with the same thing as owning the S&P 500 with an ETF like SPY, but it's tracking the same index just with some of the upside capped. All right, and then we have QQQI or 3QI, which has only been around since February of this year, up 1% so far in total capital appreciation, but it is on pace to pay a 14.4% dividend yield if we annualize their current dividends paid. This one is not tracking the S&P 500, but it's actually tracking the NASDAQ 100, which of course is just going to be inherently more volatile with all of the big tech companies in here. So there's so much anticipated change in technology, so much more innovation that's just on the horizon. So of course there's going to be more premiums on those covered calls, meaning they're going to pay out even more in dividends. Their 61-cent dividend is the highest in their short-term history, but hopefully it's a sign of things to come for this fund. Now, QQQI or 3QI, this secret of how great of an income ETF it is, it's slowly starting to not become a secret. That's because if we look at their total assets under management, we can see this fund is rapidly growing. In the last month, it has basically doubled its assets under management from 98 million all the way to 200 million at the time of this recording. This means that investors are very confident in how 3QI is handling their investors' money and getting those juicy returns. They think there's going to be more of that on the horizon. So great to see the total assets under management going up, the NAV remaining consistent, the dividends continuing to be fat. Now, just remember, investors, these are investments. These are products that are designed to generate income today. That doesn't mean investing in these replaces investing in the overall indexes. So investing in triple QI is not the same as investing in the triple Qs. There are risks. There's even potential for underperformance. But for now, the juice is definitely there. It's not free money, but it is a lot of money. And there's chances at building generational wealth right here. Let me know what you guys think about these 3 income ETFs. Some of my personal favorites, FEPI, SPYI, and triple QI. Let me know what you think of these 3 strategies and if they've helped you grow your wealth, or maybe they've even helped you lose wealth as well. So whatever it is, I want to hear it in the comments below. Make sure you check out the Patreon. It's a great way to support this small channel and also get access to my full portfolio that's been beating the overall market in the past year and a half. Remember, my videos are always found in podcast form under the Collect Cash podcast name, and I will catch you on the next one.